Time now for the word on Wall Street. Top investors watching your money. Joining me now, Payne Capital Management President Ryan Payne. Also with me here on set, Luke Lloyd. Ryan, good morning. Let's start with you on all of this.
Yes.
Take a look at futures. We've actually got futures higher, as you can see on your screen, Dow up 17 points. So we're watching this. We're really watching oil pulling up both Brent and WTI. We're seeing a boost here. The OPEC fund launching a $1.5 billion support package to help developing countries deal with economic pressures from the Iran conflict. The fund says the money is going to be deployed through 2028. The UAE, by the way, said to exit OPEC on Friday after 6 decades, a major shakeup as supply disruptions are roiling, of course, the energy markets. Now, President Trump met with oil and gas executives yesterday. This included Chevron CEO Mike Wirth to discuss energy fallout of Iran, according to Axios. Ryan, I want to get your reaction to all of that. I'm throwing a lot at you, but in particular, you know, we keep watching all the headlines coming out of the blockade.
Yes.
But the UAE walking away from OPEC is a victory, I would think, for the Trump administration.
100%, because that means there can be more aligned with the U.S. If the U.S. wants to control the price of oil, if they want to increase production down the line, they don't really have to be at loggerheads with what's happening with OPEC Plus. So I think that is a big deal. It gives them less power, gives U.S. more control over the oil market. And I think a lot of what's going on here, the overarching strategy of the Trump administration, is about the control of the flow of oil. Mm-hmm. And so I think that is a big deal. And also, I mean, I think what's interesting is, everyone's saying it, but like, you look at the market, not just the U.S. market, but global markets are really looking through this oil crisis right now. In fact, if you look at earnings estimates for companies outside the U.S., they're going up as well. So it's not just the U.S. So I think overall, what the market's telling you is, even with this standstill right now in the Strait of Hormuz, at some point here, resolution is probably the most high odds of success.
What I liked, the reason I brought that up is because the Journal's editorial wrote this, and I think this is important to bring up, why the UAE broke up with OPEC, and they say it's a foreign policy victory for American fossil fuel energy. Shale fracking in our country has achieved our long-time strategic goal of curbing OPEC. And now the UAE walking away. I think this is the broader shift that we're seeing happen right now. And I think that initially there was a little bit of a concern in the oil markets. This is going to push prices higher, and we're up today. But long term, this makes, again, the U.S. even less dependent on OPEC in the Middle East amid this conflict.
Absolutely huge. And when this conflict ends, the question is, does that actually mean oil prices even drop more? Because now, if we want to ramp up production, we don't have to worry about OPEC Plus, putting some sort of like restraints on their members. If you have UAE, which is a big part of that, not being a part of what OPEC Plus is doing is going to be huge for the U.S.
UAE, number 2 in production, storage and capacity. So that's also another component. We'll see how the Saudis continue to react to this. There's a little bit of a backstep there. All right, Luke, let's talk about this. J.P. Morgan CEO Jamie Dimon is warning that risks are building across credit and global debt markets, saying a downturn could be worse than expected, especially in private credit. He cautioned a mix of soaring government debt, geopolitics, and high oil prices could trigger a broader bond market shock, markets potentially underpricing the risk.
He's not wrong. The risks are growing. But again, the same thing with what we're talking about, whether AI spend with tech matters. I don't think the risk is there right now. It's going to be growing over the next year or two. Once unemployment ticks up a little bit, there might be a snowball effect of some defaults, and that can trigger a lot of bad things. But we aren't there yet. We have to pay attention to that. Now, I want to go quickly back to what we were just talking about with OPEC. When we got out of OPEC, or UAE got out of OPEC, the percentages was about 20% of oil production was 25% was with OPEC, 16% with the United States. With UAE leaving, it's not 20%, it's 16%. So it does make U.S. more competitive, and it's been OPEC and United States competing with each other for a while. So with us probably being able to produce more oil, or at least the capitalistic and free market system allowing to work, that should bring down oil prices, which means interest rates should go lower. So when we talk about private credit and interest rates, it's all depending on how long interest rates stay high. So if we see interest rates come down a lot over the next few years, that risk becomes lower. So
and then we go to the Fed decision, which is today at 2 p.m. The Senate Banking is pushing the Kevin Warsh nomination out today. We believe 10 a.m. Eastern time. So there's a lot at play in that.
And that goes into that because Warsh cares about unloading the balance sheet more than the caring about interest rates. So when you unload the balance sheet, that means you have a little bit of economic, not necessarily downturn, but you have a little softer economic market, which means lower interest rates. So things we got to consider when it comes to private credit.
And I also think the Treasury Secretary, that relationship with Kevin Warsh is going to be a good thing. And I think the way that they are going to unwind the balance sheet is going to be positive to watch. Let's talk about earnings, because we got a lot going on here. Big tech earnings kickoff today. And here we go. Meta, Amazon, Microsoft, Alphabet, Qualcomm, all after the bell. And investors are going to be closely watching for, of course, the guidance, but AI spending and data center build-outs, and whether these investments can actually turn into returns. And Mark Malik, as you know, that comes on the program a lot, he wrote this. He said, look, the return on spending has to show up. Massive capex with thin near-term revenue contribution creates a narrow margin for disappointment. That's the pressure on these companies tonight after the bell.
It's totally right, and I think that's what we're going to be looking at right now. Is if you saw the first quarter, they added another $95 billion to capital expenditure for AI infrastructure. So the question is, are they going to continue to spend more, and then what does that translate into earnings? And this is actually kind of crazy. If you look at the Magnificent Seven and you take NVIDIA out of it, well, earnings growth for the rest of the Mag 6, I guess, would be 13%. That's not like magnificent earnings growth when you start looking at the fact that you can get better earnings growth in the other S&P 493, I guess, sans NVIDIA. So I think the question as an investor right now, you are paying a premium when it comes to valuation. Should I put my money elsewhere? And that's kind of what I've been preaching here is okay, yes, have some money in tech, but there's so many other places right now that you could put your money where multiples are lower and earnings growth is going to be higher. So I think you have to really start to question, why do I have so much money in the Mag 7? And most people do.
Right. Well, and again, Luke, you brought this up earlier about the fact that there might be a rotation into small and mid-cap names because of this.
Already
and I wonder if we're going to see that. Well, even more so tomorrow.
Quickly, we're very aggressively into software. We've been buying this whole IGV dip and allocating to specific names. So we are aggressively positioned in tech, not necessarily into it, all these kind of different
All right.
things.
Well, we'll have to continue this later. Ryan Payne, thank you so much.
You.
Great to see you as
Great to see you.
always. Luke's going to stay with us all morning.